Welcome to the Deep Dive. Today, we're taking a fascinating shortcut, really, to understand maybe the greatest financial success story of our time. And it was built by a man, Jim Simons, who, well, most people have never even heard of. We're pulling key insights today from Jim Simons and the Quant Revolution, which itself is based on Gregory Zuckerman's fantastic book, The Man Who Solved the Market. So, our mission. We want to get into quantitative trading, figure out how it actually works, and understand how Simons and his firm, Renaissance Technologies, which is super secretive, by the way, how they achieved this just legendary track record. It basically rewrote the rules.
Yeah.
This is math-beating gut instinct.
Yeah, and I think what's really key to get right from the beginning is just how radical Simon's whole concept was back then. I mean, utterly revolutionary.
Right.
It's a complete rejection of, traditional Wall Street thinking. Forget analyst reports, forget meeting CEOs, forget trying to predict, geopolitical events. Simon's idea was, well, pretty simple on the surface. The answers are hidden in the data, and only really advanced math can find them.
Which makes a lot of sense when you look at where he came from, right? Before finance, he wasn't even in finance. He was this celebrated world-class mathematician.
Exactly. Top tier.
Solving problems that had absolutely nothing to do with, like, price-to-earnings ratios or market caps.
Right. His whole career was built on finding structure in things that looked chaotic. You should see this really clearly if you look at his earlier work. He was even a code breaker for the NSA during the Cold War. So whether you're looking at, coded messages or the wild swings of the stock market, the fundamental skill is kind of the same. It's pattern recognition, finding signal in the noise.
So he makes this big shift. He's in his 40s, leaves academia and code breaking behind, and in 1982, he starts what eventually becomes Renaissance Technologies, and this core idea starts to take shape. The market low's random, but maybe it's not.
Yeah, he was absolutely convinced that the markets weren't just random noise. They had, the source material calls them hidden patterns, faint signals buried in the noise. And crucially, he figured the only way to actually find and use these tiny signals was with algorithms, not intuition. Trust the math, trust the data analysis.
Okay, so if the market is this massive code, you need the best code breakers, right? Which brings us to one of the most famous parts of the Renaissance story, who they hired. Or maybe who they didn't hire.
Oh, yeah. He famously just didn't hire typical Wall Street types.
Yeah.
No MBAs, no seasoned traders who relied on intuition or reading charts.
There's that famous quote, isn't there? We don't hire people from Wall Street.
That's the one. He actively avoided them.
So who did he hire? This is the amazing part. He built this, ultimate brain trust of people totally outside finance. Mathematicians, physicists, statisticians.
Computer scientists, even astronomers. People who studied language patterns.
Astronomers. Why astronomers?
Well, think about it. What do all those fields have in common? They're specialists in analyzing incredibly complex systems. Right?
Okay.
Like the movement of galaxies or how language flows or the behavior of subatomic particles. These people spent their careers wrestling with huge data sets, looking for tiny signals, dealing with time series data. And importantly, they came in with zero preconceived notions about how investing should work.
So they were like a clean slate, ready to just attack the market as a pure data problem.
Exactly. No baggage. And so the firm's headquarters out on Long Island, it became this sort of secretive, almost legendary sanctuary for brainiacs, laser focused on one thing: find predictive signals in mountains of data, no matter how small or how short-lived those signals were.
Okay, let's get into the nuts and bolts then. How did this team of, non-investors actually crack the market code? When we say quantitative investing, quant trading, it's the total opposite of traditional investing, yeah.
Oh, completely opposite. They basically threw out everything a traditional investor cares about. The CEO's brilliant vision, the hot new product line, global economic trends. None of that mattered.
So what did matter?
Data. Pure data feeds. They built this incredible tech infrastructure, way ahead of its time, and its job was to vacuum up and analyze just immense amounts of historical market data. We're talking decades, even centuries of history.
Centuries, wow.
Yeah, every stock trade, every currency kick, every commodity price, everything they could get their hands on.
Yeah.
It was just this massive brute force data operation.
And the genius wasn't finding the obvious stuff, I guess. They weren't looking for big, simple correlations.
No, not at all. That's the key difference. They were hunting for tiny, non-obvious, often very short-term relationships in the data. Things nobody else was seeing or, frankly, even looking for.
The sources give a great example of this, right? Can you walk us through that?
Sure. It's a hypothetical, but it captures the idea perfectly. The algorithms might spit out something like this. Okay, if Currency X in, say, Asia wiggles up just a tiny bit,
Yeah.
and at the same time the price of oil stays completely flat for that hour, then there's maybe a 51% chance that stock Y, a tech stock in the U.S., will nudge upwards in the next couple of hours.
Hold on. 51%. That's barely better than a coin flip, just 1 percentage point edge. If you or I tried to make money on that, we'd be broke in a week. How does that lead to market domination?
All right, and that is the absolute core insight. That's what separated Simons from basically everyone else.
Yep.
On its own, that 51% chance is almost worthless. It's a tiny, tiny statistical lean.
Okay.
But the genius of their quant approach has, like, 3 parts.
Yeah.
Scale, speed, and compound.
Via compounding. Okay.
So first, scale. You don't find just one of those weak signals. You find thousands of them across all sorts of assets, all sorts of tiny correlations. Second, speed. You build an incredibly fast, automated trading system that can execute trades based on these signals almost instantaneously.
Yeah.
Millions of trades every single day.
Millions.
Millions. Faster than any human could possibly react. And third, compounding. When you combine thousands of these tiny 51% edges and you trade on them relentlessly millions of times, that microscopic edge starts to compound. It adds up. They weren't swinging for home runs. They were hitting millions and millions of perfectly executed base hits, day in and day out.
So it's leveraging the sheer volume and speed to let the tiny statistical edge win out over the randomness in the short term. It really does turn investing into this kind of statistical factory.
That's a great way to put it. Statistical money-making machine.
And this machine produced results that are, honestly hard to believe. Which brings us to the Medallion Fund, the crown jewel of Renaissance.
Ah, yes, Medallion. It's legendary partly because, well, you can't invest in it anymore unless you work there. It's been closed to outsiders since the early 90s, basically a perk for employees and their families. And yeah, it's widely considered to have the best track record in the history of investing, period.
Let's put some numbers on that because the context here is just wild. Give us the data for the listener.
Okay, get ready for this. From 1988 to 2018, it's a 30-year stretch.
30 years.
The Medallion Fund generated an average annual return of 66%, and that's before fees.
66. 66% average annual return. That sounds completely made up. Just for perspective for you listening, Warren Buffett, maybe the most famous traditional investor ever, he's averaged somewhere around 20% annually over his best periods. Simon's math machine was doing 3 times that.
It's staggering. Now, the fees, that's another fascinating part of the story. Renaissance charged fees that were also legendary, but for being incredibly high. You know the standard hedge fund fee structure, often called 2 and 20?
Yeah, 2% of assets under management and 20% of the profits.
Right. Well, Renaissance.
Yeah.
Rumors are they charge fees as high as 5 and 44.
5% management fee and 44% of the profits. They were keeping almost half the winnings.
Pretty much. But here's the kicker. Even after they took those massive, historically huge fees, the net return, what the investors, the employees actually got to keep, was still an average of 39% per year.
39% after fees, that's still nearly double Buffett. They could charge those insane fees because the machine just kept delivering, didn't it?
It did. They had total confidence in the model. And what's maybe even more impressive is how robust that system was.
Right.
Think about the market chaos during that 1988 to 2018 period. You had the dot-com crash around 2000.
Wiped out fortunes.
Exactly. And then the massive global financial crisis in 2008. Catastrophic for most funds.
Yeah.
Medallion. It basically sailed right through them.
Oh.
Minor bumps in the road. The system was so resilient because its edge wasn't tied to, like, the overall economy being good or investor sentiment or housing prices.
Right. It was tied to those short-term statistical correlations.
Precisely. So when the market went crazy, the system just found new short-term statistical patterns to exploit within that chaos. It adapted.
Incredible. Okay, so this amazing story of, mathematical conquest. What does it actually mean for you, the listener, maybe outside of high finance? Because this feels like a blueprint for solving complex problems anywhere. What are the big takeaways the sources emphasize?
Yeah, there are some really powerful lessons here. We've kind of distilled 4 key ones. First, talent in unexpected places. Simons totally proved that you should hire for raw analytical problem-solving ability, for data fluency, not necessarily for specific industry experience.
So that astronomer might actually be better at solving, say, a logistics problem than someone who's been in logistics for 20 years?
Potentially, yes, if they have the right analytical toolkit. The second lesson, trust the data. Absolutely. This is huge. It's about fighting our own human nature, our gut feelings, our biases. The Renaissance team had to follow the model's output, even if a trade felt completely wrong intuitively.
The machine knows best, basically, even if it feels weird.
That was the discipline. Third lesson, the power of open collaboration. Renaissance wasn't run like a typical secretive hedge fund internally. It was structured more like an academic department. Yeah.
Interesting.
Physicists, computer scientists, mathematicians, they openly shared ideas, debated algorithms. That collaborative environment sparked breakthroughs that probably no single genius working alone could have achieved.
Makes sense. Collective brain power. And the last one.
The final lesson really underpins everything. It's Simon's original big idea. The market is not entirely random. He provided pretty definitive proof that exploitable patterns do exist, even in systems we think of as pure chaos, if you have enough data and enough computing power to find them.
So wrapping it up, the source material paints this picture of the greatest financial wizard of our time, not being some slick trader, but fundamentally a code breaker, someone who treated the global market like one giant mathematical puzzle just waiting for the right algorithm.
It's quite a story, and it really shows how that relentless focus on math and computation just completely upended Wall Street and kicked off this tech arms race in finance that's still going on today.
It really makes you think, doesn't it? And this is maybe the final thought for you, the listener. If even the financial markets, which seem so chaotic and driven by human emotion, if even that yields patterns when you throw enough data and computing power at it, where else might that be true? In your own life, in your own field? Are there systems you're dealing with, maybe customer behavior, resource flows, market trends that you've just written off as random?
Yeah, what complex problem have you maybe assumed is just noise, when actually it might be a complicated pattern just waiting for the right data, the right model to unlock it?
Something to think about, maybe something worth coding for.